Last week, mortgage rates dropped to the lowest they've been all year after a crazy week of data. We had the CPI inflation report, then we had the PPI inflation report, then we had a retail sales report all in 1 week. And even though inflation came in hotter than expected, mortgage rates actually came down. We'll talk about why in a minute. Overall inventory as well as new listings both increased this week. And as expected, the number of people applying for mortgages continued to decline, which will be normal until about the first week of March. Collin County had a huge jump in pending sales this week and actually has just about as many homes pending today in the middle of February as it did at the end of April last year. So we're having way more sales this year than last year. We're covering all of this and much more in this week's market update. My name is Michael. I'm a real estate agent here in the Dallas area, and every Monday I give you a weekly update covering all of Dallas and Collin counties as well as the national market. We're looking for trends. We're tracking mortgage rates as well as mortgage purchase applications, as it's our best leading indicator to what demand will look like 30 to 90 days from now. We're looking at things like median list price, days on market, how many homes are having price decreases, what's inventory looking like, and if you stick around until the end, it's my favorite part, the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin counties. If this sounds like something you're into, make sure and hit the subscribe button. And if you're looking to buy, sell, or invest in the Dallas-Fort Worth area, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that is in the description below. Okay, today is February 17th. Let's see what the data is telling us. And if this is an old video, you can click the playlist here and it'll take you to the latest weekly market update. Starting with market news, we're going to talk through all three of last week's reports, what they showed and how they ultimately resulted in lower mortgage rates, even with inflation going up. First up, on Wednesday, we had the CPI inflation report. This is the Consumer Price Index, which tracks how much are consumers paying for things. This report showed CPI inflation increased 0.5% in January after having risen 0.4% in December. And over the last year, overall inflation is up 3%. And then core CPI inflation is up 0.4%, which is also hotter than expected. Something important to note about core CPI is that the shelter component, which is basically just the cost of rent prices, makes up 44.2% of this inflation number, which is important because core inflation accounted for 41.5% of that month-to-month increase. After that, the transportation sector accounted for 36% of the month-to-month increase, and inflation has been growing in the used car market for several months now. And then of course, as you keep hearing, a bird flu is driving up the egg prices. Okay, looking at this chart, this is showing the core CPI inflation, but it has the shelter component of that removed so you can see what's really happening a little more clearly. So, as I said, the shelter component, this light red line up top, makes up 44.2% of the overall core CPI. So you can see this number lags way behind the rest of these inflation numbers because they're tracking rents, which means a minimum 1-year lease in most cases. So this data is usually lagging by like an entire year. So as you can see on the light red line, we are actually still seeing disinflation in rents. And the reality is, if there were a way to track rent inflation in real time instead of this big lagging indicator, then CPI, overall core CPI, would be much lower. What I'm trying to show you here is that when you zoom in on the data, it's not as scary as it sounds, and in reality, core CPI without that lagging shelter component is just continuing sideways, exactly sideways. It's literally just been bouncing from 3.2 to 3.3 back and forth since June of last year. So it's really been, this is just totally sideways. So if this remains sideways and the shelter component finally comes down like it is, then inflation is going to be much lower even with this going sideways. So right out the gate, inflation came in hotter than anticipated, and the result of this was mortgage rates jumped from 7.04% up to 7.13% on Wednesday. But then on Thursday, we got the PPI inflation report. So CPI inflation is for consumers, PPI inflation is for producers. And the PPI inflation report came in hotter than expected as well, up 0.4% in January when it was expected to be 0.3%. So you would think this would send mortgage rates even higher. But just like with CPI, when you zoom in further, the core components are showing signs of softening. And putting all the data together, it's now estimated that the core PCE, which is Personal Consumers Expenditure Report that will come out later in the month, and which is the actual inflation report that the Fed relies on more, is likely going to show a 0.22% increase, which would be down from the 0.45% in December, and that's according to Citigroup estimates, which then would push the annual inflation rate down to just 2.5%. So I know it's probably a bit confusing that inflation can look up in one report and then somehow the same data indicate that inflation is actually coming down in the next report. But that's just because they track things differently and they weigh things differently. And that's why it's always so important to zoom in and not just look at the headline data. So we had the Wednesday report, mortgage rates jump up to 7.14. Then we had the Thursday, which then indicated that the PCE number might actually come in lower, and then mortgage rates came right back down to 7.05. And then came Friday. On Friday, we got the retail sales report. The retail sales figures missed expectations and dropped 0.9% last month, which is the biggest decrease since March of 2023, which would be a big indicator that people are slowing down their spending, which leads to less inflation. Now, a lot of people are speculating that it's because we had a lot of freezes last month, we had the wildfires going on in California, so environmental factors across the country could be a big reason why people were out spending less money. But in any case, the low sales report dropped the 10-year, and ultimately mortgage rates fell back below 7% for the first time all year long, even though inflation went up. So, crazy week of reports. I hope that made sense, but that's enough of that. Let's move on. Last week I showcased this new community coming up in Denton, Texas that's going to be very affordable, great location, great floor plans, big yards, 4.5% mortgage rates, all of your closing costs paid for if you buy soon. The community just opened up and they've already sold over 50 homes without even having a model home there for you to look at, which just tells you how affordable and in demand these things are. It also means the longer you wait, the more you're going to pay there. When it opened a few weeks ago, the smallest plan was just under $300,000, and as of last week, they had just one available for $317,000. That's probably sold now, and the next one's going to be a little more expensive. And that will continue happening the longer you wait as we head into the spring market. But plans range from 1,450 square feet up to 2,091 square feet. All the homes here are going to be single story. Putting the minimum down with the current incentives on the smallest plan, you would only need $11,100 total cash to buy this home, and your monthly payment including taxes, insurance, and HOA would only be about $2,489 a month. So if you're interested in that, I toured 3 floor plans and showed you the area in this video you can watch next. Moving on, let's start with national housing inventory. This week we had an increase of 5,624 more homes for sale in the country, which gets us to 29% more inventory than we had last year, to a total of 637,991 homes available for sale in the country. This same week last year, inventory was only at 493,987, so doing much better this year with inventory. Then for reference, the all-time inventory bottom in 2022, we only had 240,000 homes for sale. The peak of last year, we had 740,000 homes for sale. This same week in 2015, we had about 955,000 homes for sale. So you can see this line here, inventory is getting way back up to normal. We need to be more up here to be normal, but we've come a long way from this line. It's crazy to think how many years it's already been since COVID. Now looking at new listings, this week we have 7,003 more new listings than we did last year, for a total of 56,559 new listings this week. You can see it here. We are finally firmly above any of the last 3 years as far as new listings, and we hope that this will continue. But this is great news. More and more people are listing their homes again, which means more inventory for you to choose from and less chance of prices running up quickly when rates finally drop again. Now looking at pending sales, nationally this week we have 3% fewer sales pending than we did last year. It's not really unusual. This data gets very tight at the beginning and end of the year. And so far we've been following very closely to both of the previous years. When we're going to really see stuff is going to be around March, April. That's when we'll really see what's going on in the market. But overall, this number should continue trending up until somewhere around late May, early June. And as of now, we have 303,957 homes pending in the country, which is about 15,000 more than we had last week. The last thing we cover nationally is the percentage of homes having price decreases. Every year it's normal for a third of homes to take a price cut before selling. Looking at the national chart, we had a small drop down to 33% of homes having a price cut this week. So as you can see, we're starting the year a little higher. We are currently flat, but somewhere between here and here, we should start seeing this climb. So not yet, maybe we remain flat for a couple more weeks and then start to climb. Also, don't think just because we're starting higher that means we're gonna hit a higher peak for the year. That doesn't have to be the case. As you can see with these 2 years, the climb started at much different times, but they ended very closely at their peaks. And actually last year we got as high as 39.9%. The year before we got as high as 39.2%. So very close in peaks, they just happened at different times. And then in 2022, we went from 18 or 19%, ran all the way up to 43.2%. But just so you know, if you want home prices to come down, this number needs to be going up. And around 33%, that's the normal number. Now moving on to mortgage rates, as we talked about last week, we started at a 7.01 after that first report got as high as 7.13. And we ended the week at a 6.96, the first time below 7% all year. Then regarding mortgage purchase applications, you can see we had a 2.3% decrease in the number of people applying for mortgages last week, but looking at the chart, we are still 2.4% above where we were a year ago, and we should be expecting drops for the next 2 weeks. I do think that's likely because people are preparing their taxes, and somewhere around here they get their tax returns. A lot of people use those for their down payments, as well as they need to have their taxes done in order to apply for a mortgage. But as you can see, this data is very volatile at the beginning of the year. After these next couple weeks, that's when it gets a lot more reliable and we can really see what's going on with the number of people applying. But I've been saying it for more than a year now. I still believe it. There's no reason to believe mortgage demand is going to grow significantly with rates anywhere near this high. The real demand comes in once rates get and stay below 6% for a sustained period. We know this because we see it in new construction. They've been offering lower than 6% and they've been selling just fine for the last several years. Okay, now let's move on to the local markets, starting with the MLS data of Dallas County. So last week we had 525 new listings. As you'll remember, the national market had more new listings. In Dallas, we had 90 less new listings. We had 279 closings, which is 58 more than last week. 52 of those were immediate sales, meaning they contracted within the first week. That's 8 more than the previous week. 282 contracts this week, that's 35 less than last week. And in total, there are 2,065 homes either under contract or pending, and that's 64 more than last week. So less contracts and less new listings. Now moving on to Collin County, we had 393 new listings, which is only down 6 from last week. 201 closings, that's up 51. 33 of those were immediate sales, that's up 9. 181 new contracts, which is only 4 less. So new listings and contracts were down in Collin County as well, but just barely, whereas in Dallas it was a lot more noticeable. But in total, 1,762 homes either under contract or pending, and that's 119 more than last week. Now we're moving on to the Market Action Index. If you've never seen it, it just takes into account all this data, puts it into one easy to read graphic with a number. Anything at 30 or below is a buyer's market. Above a 30, we're asking how much of a seller's market are we in? We are currently at a 38, a slight seller's advantage, which is the highest we've been at least since November 1st. So you'll see the difference here in Collin County, but basically what we use this for is to say, is anything looking weird? Is there anything we need to be concerned about? What would be normal this time of year is the Market Action Index to start heating up. This actually, it's not really normal for it to be heating up since November. Normally it should start heating up now, which you can see it did remain a little bit flat here and now it is starting to heat up. But I would say this part was unusual. Collin County is going to look a little more normal when we look here in a minute, but prices still have not climbed. So you can see the market is heating up, but we've not yet seen it reflected in the prices. In fact, we have been flat for 3 weeks now, pretty much entirely flat. Median price of new listings as well. I call that flat because it's just going sideways, straight up, straight down, right back down. Average days on market has been holding very firm as well. Median days holding firm at 77. Number of homes having price decreases, barely any change all year. Total inventory is growing, but barely. I mean, that's pretty flat the last few weeks. But all of this to say, everything looks normal. What should be happening right now is things should be heating up through May or June. It's not yet reflected in the price, but it is only mid-February, so that actually is normal. Which also means if you're wanting to buy a house, every week from here on out is going to be your best chance at a low price. So every week that you wait, you have a lower and lower chance of getting a low price, if that makes sense. Okay, so Dallas is a 38, slight seller's advantage, but it is heating up. Let's go to Collin County. Collin County, as we talked about, as of last week, they had not found a bottom for their prices, but as of right now, there's only a 50 cents difference. I don't think I've ever seen a 50 cents difference, but 2 weeks in a row, so that looks like we might be finding a bottom for prices, which that is more normal for somewhere around here to actually be the bottom of prices. Median price of new listings has been going sideways for a while, just like Dallas. They are a 35 slight seller's advantage, and you can see, let's see, yeah, okay, so this is a much more normal looking market action index where it's bottoming somewhere in January and then slowly starting to heat up. So that's more normal. Average days on market had a 1-day drop. Median, though, somehow had a big drop, so they're down to 63, which that's lower than Dallas. Number of homes having price decreases is quite a bit higher at 42, but it's just holding flat. Inventory as well has been much more flat than Dallas. But overall, still everything's looking totally normal. They are just now starting to heat up. Their prices look like they just now might be finding the bottom, which again just means every week you wait from here, it's probably going to start going up, all the way until probably end of May, early June. Okay, quickly, I wanted to show you the pending sales of Dallas County. All I really wanted you to see is this black line is quite a bit above the previous two lines. So sales are growing every single year. And then I wanted to show you Collin County, because Collin County had a huge jump up this week, and their line is obviously, this black line is way above the previous two. Just an obvious representation. There is a ton of growth happening in both Dallas and Collin counties, which is also why we have a lot of investors buying here, because this means there's a lot of demand. Where there's a lot of demand, prices are likely to go up. All right, now we're moving on to the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin counties. These are ranked using that same market action index number we discussed. Remember, 30 or below is a buyer's market. So starting with the absolute hottest city, number one remains and has been for many, many months, Carrollton, Texas at a 47.53, followed by Louisville, which heats up 4 spots. Plano heats up 1. Coppell heats up 2, Richardson cools off 2, Grapevine heats up 2, Grand Prairie remains, Balch Springs jumps on at number 8, Allen heats up 1, and Irving jumps onto the list at number 10, and then Saxe and Ferris both fell off of the list this week. Then we like to zoom into specific zip codes. The absolute hottest is Carrollton, 75007, followed by Plano, 75093, Grand Prairie, 75052, Plano, 75025, Dallas, 75234, Carrollton, 75006, Louisville, 75077, Richardson, 75080, Grand Prairie, 75051, and Richardson, 75082. So if you have a house in one of these zip codes, you should be able to sell for top dollar. Now looking at the same thing, but the coolest cities and zip codes, Blue Ridge, which had actually gone up to number 3 last week, came all the way back down. It's usually the coolest. It has been for many months other than last week. But it cools off 2 spots right back to the bottom at a 27.98. So everything below Van Alstyne and below, these are all the buyers markets. Then Sunnyvale heated up 1, Lavon cools off 1, Van Alstyne cools off 2, Leonard heats up 3, Royce City cools off 4, Rockwall, Salina, and Anna all remain at their 7, 8, and 9 spots. And then Nevada heats up 5 spots. It was way down here last week. Then looking at the specific zip codes, the absolute coolest remains Blue Ridge, 75424, followed by Grand Prairie, 75054, Sunnyvale, 75182, Lavon, 75166, Van Alstyne, 75495, Leonard, 75452, Rockwall, 75032, Royce City, 75189, Duncanville, 75116, and Salina, 75009. As always, if you're looking to buy, sell, or invest in the Dallas-Fort Worth area, I would love to connect. Call, text, or shoot me an email. All that is in the description below. Thank you for watching. I'll see you in the next video.